Hi, I'm John Stewart, Chief Investment Officer of Farmers Trust Company. This is the Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Hi, I'm John Stewart. Welcome to the latest edition of the Investor's Edge. First up, the week in review. Stocks pop, then drop to start the new year. So as I expected, the Santa Claus rally in stocks came right on schedule this year during the last 2 weeks of December and into the first 2 trading days of 2022. Then on Wednesday, the S&P 500 index dropped roughly 2%, while the tech-heavy NASDAQ index was actually down more than 3%. I've been warning the last couple of months that a reduction in the Federal Reserve's asset purchase program would begin to cause higher levels of volatility in the market. And this is likely the beginning of a rockier stretch for stocks. Now, don't misinterpret that to mean that the world is coming to an end and you should rush out and sell all of your equity holdings. It does mean, however, that if you have been pressing your luck on risk, it could be time to rebalance your portfolio a bit. It also means you're going to have to be a little more discriminating in the types of sectors and stocks that you have exposure to. Many individual stocks actually finished Wednesday with gains, despite the overall market being down between 2 and 3%. For this week's featured insight, making money on bonds with low interest rates. So many investors have been increasingly shunning the bond market because of persistently low interest rates. Why would anyone want to own a 10-year Treasury that yields less than 2%? You're not even keeping up with inflation. Now, while holding that bond for 10 years is certain to produce a small rate of return, you can in fact make substantial capital gains while holding long-term bonds for shorter time frames. For example, if the 10-year Treasury rate were to drop from its current 1.7% down to 1 in the next 6 months, you could sell your bond for roughly 7% more than you paid for it. Buying a 30-year bond could actually produce a return nearly 3 times that for a similar move lower in interest rates. Make no mistake, however, the reverse is also true. If rates rise substantially, trading bonds in this fashion could be risky and should only be done with the consultation of an investment professional. Looking ahead, inflation likely to moderate. Now, I've obviously talked a lot about inflation, and now that everyone is aware of the accelerating inflationary pressures we've all been feeling, guess what? They're actually likely to start cooling off a bit. Keep in mind, however, a falling rate of inflation is still inflation. It just means that prices are going up at a slower pace. Now, this does, however, have implications for the performance of various asset classes. Commodities, which were one of the best performing asset classes of 2021, are likely to experience some downside risks in the coming months. It may also mean that the longer-term bonds I just talked about will become a more attractive investment option. In addition, utilities and consumer staple stocks will likely perform well, even if the overall market struggles for a while. Now, the December Consumer Price Index, or CPI, will be reported this coming week, and it will likely show a rate of inflation somewhat lower than November's blazing hot 6.8% reading. Stay tuned, and we'll discuss going forward. Once again, I'm John Stewart. Thank you for watching The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.